Welcome to The Explainer. Today, we are diving into the massive macroeconomic surge we're seeing in copper prices, and more importantly, tracing exactly how those microeconomic ripple effects make their way straight to your wallet. We're looking past the daily tickers here to see how a spike in just one single raw material is literally shifting the ground beneath major industries.
Here's our roadmap for today. We'll start with the copper price surge, look at AI and structural demand, then check out the cable industry margin shock, the pressure on transformers and electricals, why consumer durables are getting pricier, and finally ask, will the bubble burst?
Okay, part 1, the copper price surge. So, copper is basically the absolute nervous system of our modern infrastructure, right? Which means we really have to ask, why is this fundamental building block suddenly getting so incredibly expensive? Well, it's not just one thing. It is a perfect storm of policy changes, pure panic, and some serious production bottlenecks.
Get this, prices on the London Metal Exchange recently skyrocketed to a staggering $13,387 per metric ton. The trigger? We saw severe physical mining disruptions hit major hubs like Indonesia and Chile. But honestly, that shortage was massively compounded by pure panic buying. U.S. buyers were just frantically stockpiling the metal to get ahead of proposed 15% import tariffs.
Moving on to part 2, AI and structural demand. To really put this into perspective, think about a traditional internal combustion engine car. It uses about 23 kilograms of copper. But an electric vehicle? 83 kilograms. That's nearly 4 times the copper per vehicle. You're talking about the weight of a full-grown adult man, just in pure copper alone. So when you scale that up across all these global EV adoption targets, the baseline demand for this metal just permanently shifts upward.
And we can't ignore the AI boom. The massive, ongoing construction of AI data centers relies heavily on copper's unique thermal properties for all those complex cooling systems. Add to that the fact that solar power requires over 7,000 tons of copper for every single gigawatt generated, plus wind turbines, plus EV charging infrastructure, and you can clearly see how the electrification of literally everything is putting immense, unexpected pressure on a supply chain that was already pretty fragile.
That brings us to Section 3, the cable industry margin shock. It's actually wild to see just how dangerously exposed some of these primary manufacturers are. For companies like Polycab, RR Cabell, and Finilex, raw materials aren't just some minor line item. I mean, they eat up to an astonishing 85% of total expenses. In an industry where the average profit margin normally hovers around 10 to 12%, a spike in raw material costs like this is an absolute margin killer. And here's the real trap. They can't just downgrade their materials to save a quick buck. Industrial and domestic cables absolutely require highly refined 99.97% pure electrolytic-grade copper. It is non-negotiable for safety and efficiency. They can't swap in cheaper mixed metals or low-grade aluminum without risking catastrophic power loss, or worse, fires. So, until they can successfully pass those costs on to buyers, their profit margins just take a direct, brutal hit.
Next up, Part 4, Transformers and Electricals Pressured.
It's not just the wire makers. Even heavy-duty electrical giants are feeling the heat. Take ABB India, for example. They actually just reported a massive 87% profit jump on their past orders. Sounds great, right? But at the exact same time, they are sounding the alarm over shrinking future margins, warning everyone of a potential 100 to 200 basis point contraction, all because of these specialized metal costs.
So, how do you manage this pricing chaos without going bankrupt? Well, the electrical industry leans heavily on standardized price variation clauses. Organizations like IEMA, that's the Indian Electrical and Electronics Manufacturers Association, provide these dynamic pricing shields. Basically, these clauses allow electrical contractors to legally and constantly adjust their long-term project pricing based on these wild metal fluctuations, effectively shifting that burden right down the line.
Section 5. Consumer durables get pricier. Ultimately, this brings us to the final destination, your wallet. Here is the sequence of pain for the air conditioning industry right now. First, you take a 33% year-over-year rise in copper prices. Then, you add stricter energy efficiency norms. Compound that with a weak rupee, which makes imports so much pricier. The end result? Brands like Voltas and Daikin are forced to pass a 5 to 15% price hike directly onto you, the consumer.
But there's a really fascinating psychological twist here.
Despite paying significantly more for these appliances, buyers are still expected to drive 15% growth in the AC market this year. Unseasonal rains aside, people are buying simply out of pure desperation to beat the forecasted severe summer heat. Basically, the sheer need for cooling is completely outstripping the pain of the price tag.
Which leads us to our final section, Part 6, Will the Bubble Burst?
Surprisingly, the macro data tells a completely different story than the flashy headlines. Despite the localized panic and all that aggressive hoarding happening in the US, the global market actually recorded a massive 600 kiloton surplus last year. Yeah, a surplus. This is largely because actual consumption of refined copper in China, who happens to be the world's biggest buyer, weakened materially.
And because of that underlying, quiet global surplus, major financial institutions see a correction coming. Goldman Sachs is predicting that once the political uncertainty around those U.S. import tariffs finally settles down, the panic buying is going to stop. They forecast prices will drop from those record highs down to a fair, more fundamentally sound $11,000 per ton by the end of the year.
So as we continue to electrify absolutely everything, from the cars in our driveways to the massive AI data centers powering our digital lives, this explainer leaves us with a critical question. If this global copper rush is structurally inevitable, how much more volatility are everyday consumers going to be forced to absorb before prices finally stabilize? Thank you so much for joining me for this explainer, and I will catch you in the next one.